Market View on Money FM 89.3.
Well, it's official. Tuesday was a very good session for most markets across the region. The Straits Times Index, for one, jumping by more than 4% today, and also a good day for markets in mainland China. You can also count the Hang Seng, which also managed to extend recent gains, rising by more than 2% in today's session. This was a rocky start, though, to the second quarter, but there are signs that investors are finding more cause to smile and perhaps extend gains. And this could have something to do with the sudden barrage of liquidity from major central banks across the world. So how is this impacting or setting things up for markets in the second quarter? Will this lead to more volatility and short-term gains followed by losses? Or could this actually be the start of a slow but steady recovery for markets, especially markets out in Greater China that are expecting dismal first quarter economic numbers when the first quarter GDP is released next week, Friday? Well, today in Market View, we're joined by Mr. Peter Chun, the founder of Silverbear Capital out in Hong Kong, to give us his insights into what to watch out for in the next 3 months and for the rest of the year, especially with the COVID-19 pandemic continuing to hit most markets and most economies across Asia. Peter, thanks so much for joining us, and I hope that you've been in good health and are staying safe in these very challenging times out in Hong Kong.
Well, good afternoon. Yes, thank you. Actually, we're doing okay still in Hong Kong, but we're in this kind of half lockdown situation here still with the virus.
Believe you me, Peter, that us here in Singapore, we can empathize greatly with that. We are going through the first day of our circuit breaker measures. But let's talk first about the changing landscape, especially with regards to liquidity for markets right now. As you know, in the last couple of weeks after markets fell into bear territory, there's been a lot of liquidity that's been unleashed to keep economies and markets functioning. But the question now is, where is all of this new cash going? And why does it seem to be such a need for a liquidity crunch? And could all of this cash actually be unleashed at a later date once markets calm down? Why is it stuck, and where do you think it is stuck right now, Peter?
Well, there's a couple of elements in this topic, I think. First of all, I mean, you on the retail level, you can see that traditionally a lot of the cash goes into the real estates in Hong Kong, whereby right now, because of the situation, people are pulling out from the real estate developments, or maybe investments, or maybe stop buying houses, or actually wanted to cash back just to make sure that they have the flexibility with their assets. Now, and of course, the stock market is the next good toy for most of these investors in Hong Kong, and therefore we are seeing a lot of that kind of money moving away from the real estate investments back into the stock market, making it more interesting now. Despite, that everybody thinks the market should be actually slow because of the virus, but actually it worked the other way around right now.
Now, Peter, you mentioned there's some money moving from the housing markets or the property markets into equities at the moment. Is that the reason why Hong Kong's stock markets, for instance, have been rather ebullient? We have seen housing prices in Hong Kong come down significantly also. Is this just a matter of folks actually just saying that we've got cash, or we're trying to get our positions out of the property market, but we've got to make it work, so we have no choice but to get into the equity markets? Is that why we're seeing a bit of a bounce there?
Well, yes, of course. But again, because there's a mixture of real estate issue in Hong Kong as well, because first of all, the pricing are extremely high and has been supported by China buyer most of the time for the last couple of years, whereby now it is closely impossible for them even to try to travel down to Hong Kong to even look at any opportunity at all. That's the first thing. Second thing is the local government is finally coming down to a resolution to provide social housing plan and to make it work finally. So again, there will be a lot of supply in the market for the upcoming 5 years to 10 years time, fulfilling the problem with the middle class, or actually the lower end of the population, whereby they cannot afford housings with the high real estate price that everybody has been facing for the last 10, 20 years in Hong Kong. So now with that in mind, this would add to the existing equation about what's happening in the real estate market, and to a lot of the developers, especially, and you backfire back to the Hang Seng Index, because a lot of the driver in the Hang Seng Index is actually driven by these large, giant real estate developers.
Now, I want to go back to the real estate developers just in a bit, Peter. But since we are seeing this liquidity starting to boost markets in Hong Kong, it seems that it's a liquidity boost. But then again, we're still dealing with potentially dismal numbers. We've heard from Hong Kong's Financial Secretary Paul Chan. He's admitted it could be at least 6 months minimum before we see any signs of improvement for Hong Kong's economy. Could there actually be some downside risks once we start to figure out how bad some of these numbers are going to be, not just for Hong Kong, but also for mainland China, in spite of this liquidity bounce we're getting?
Well, I would believe the Secretary Paul Chan is telling the truth this time.
Right.
There is quite a bit of problem right now due to the virus, and actually shifting the whole pattern of how the retail consumer end is happening, is shifting is basically reshaping how people live in Hong Kong. Now, the economy-wise, again, because the stock market looks actually better than it looks right now from the surface, and there will be some bargain hunters going around town trying to find the good deals or the bad deals that maybe actually what they think is good deal continues to be the good deal. Now, I would probably say the stock market is overheating a little bit for some reason, because I think the actual numbers on the balance sheets of each company is not going to improve too much during these years. And if anybody is going into the market right now, would have a long-term view on some of the companies that they have confidence with.
All right, we're still speaking to Peter Chun, the founder of Silverbear Capital out in Hong Kong, to talk about the outlook of the Chinese market. Peter, as we know, mainland China, big parts of that economy and that country are starting to come back online. People are getting up off the canvas, getting out of their houses, ending some of these big lockdown measures also. But a lot has changed because of some of these very drastic lockdown measures that they've initiated to control the COVID-19 pandemic's spread across mainland China. And has it made any change into how consumers actually spend, and how is that guiding, say, outlook for the Chinese markets moving forward? Could this actually make up, for instance, a manufacturing slump? Will this start to play a more important a driver, at least, for Chinese markets moving forward? Basically, talk to us about if you're expecting any consumer habit changes long term because of these lockdowns.
Well, the manufacturing slumps is a result of a cut down with exports, obviously, because all the other territories outside China is facing the virus problems as well. And therefore, manufacturers originally are going to produce, say, 100 units or 1,000 units, has to cut back quite a bit because of the situation outside China. Now, consumer internally has not changed, because you have over $1 billion also not dollar, but people to feed here. So the consumer market in China is going to stay alive. But however, they're not going to slow down too much because of the rise. Just because they still need to eat, they still need to live. Now, by changing the model a little bit, we are seeing a lot of companies are adapting the online world right now. For example, you don't go out to a restaurant to eat anymore, but you order online, you take away food, and then you get your food at home through the restaurants. So the consumer market in China is going to stay alive without too much of a problem. But again, with the manufacturing slump that is happening, is because you have the U.S., you have the Canada, you have Europe, Italy. All these people are actually importing goods from China, but now they're going to put a hold on it because they have other things more important to fight with.
So with all of this, Peter, all these drastic changes that have happened, how is all of this shaping your strategy in terms of looking for gains in global markets in the second quarter, and also mitigating risks, because there still are a lot of uncertainties and a lot of bouts of volatility that could happen in in the second quarter, right? How are you balancing the need to find returns and also mitigating risks in the second quarter? Basically, your strategy moving forward.
Well, anything that has an online component, anything that has a cellular component, we looked at, we like. Medical supply, we like. Biotech is something that we still look into, depending on the situation. And then we're moving away definitely from the real estate market for the time being. And we'll look at, I think, environmental is another thing that is still doing good for us at the moment, despite on the virus situation.
All right. Peter Chun, founder of Silverbear Capital, thank you so much for joining us today on Market View. And as always, we wish you and your loved ones safety and good health as we ride out these challenging times and try to wait for the pandemic to pass, hopefully sooner rather than later. Good afternoon to you, sir.
To listen to more great interviews, download our podcasts at moneyfm89.3.sg or download the SPH radio app available on Google Play or the App Store.
Thank you for your time, sir.